Thank you, Brad. I appreciate the opportunity to be here and talk to you about the logistics portfolio market or property market in the U.S. It's a market I've been involved in for a little over 20 years now, and I've spent the better part of that trying to convince investors to be excited about owning warehouses. It's nice that it's finally come around. We're now, there's a little more excitement around investing in logistics properties in the U.S. I might slip and call it industrial, as it's known in the U.S., I've tried actually to get people to call it logistics and distribution centers, even in the U.S. That sounds better than warehouse or industrial property. The market in the U.S. is the largest distribution market in the world. A little over $1 trillion in investable assets, so that's a significant part of the market. It's a very diverse market, echoing Data and John, like the office and apartment sectors. It's very diverse across the country, and there's actually a great number of markets beyond just the two coastal markets that a lot of people think about when they invest in the U.S. There's a concentration around population hubs, but also on transportation locations. So some places where you might not think about are actually good investment markets for logistics properties. Places like Memphis, Tennessee, or Louisville, Kentucky, which might not roll off the tongue if you're investors coming to the U.S., but those are places where FedEx has a hub, the largest package sorting facility in the world is in Memphis, Tennessee. Louisville, Kentucky is a large UPS facility. So even though those aren't huge population bases, they drive a lot of logistics demand around those facilities. Similarly, there's other types of transportation. Certainly the two major ports on the East Coast, Newark, New Jersey, on the West Coast, Los Angeles and Long Beach, drive a lot of demand. As well as the rail and highway system in the U.S. It's a large, diverse country with a lot of demand drivers, so you have to know those drivers. The other aspect of the market is the logistics sector is very diversely held, probably the most diversely held ownership amongst all the major property types. That's a number of factors. One, it's probably the newest of the institutional asset classes, as Brad just talked about. It's really just been in the last, I'd say 20 years that it's been institutional, but certainly in the last 10 years grown in importance. And now most of our major U.S. investors have a specific industrial allocation that they're looking to get. But what that's driven is a lot of diverse ownership. In fact, public ownership, there's probably 5 or 6 public companies that own industrial property in the U.S., but they only own about 15% of the market. Then private equity ownership, like our firm, owns probably another 15 to 20%. Then there's ownership, foreign ownership, direct ownership by U.S. insurance companies and pension funds. But individuals and family businesses account for about 40% of the ownership of industrial property in the U.S. So there's a real wide, diverse ownership group within the country. So the map here shows sort of the respective pockets of ownership, and I think it's interesting. Certainly here on the East Coast, around the ports of Newark and New Jersey that I talked about earlier, certainly huge demand drivers there. But what's maybe lost there is some of these markets here in eastern Pennsylvania growing in importance as the markets around Newark and New Jersey become congested with traffic, as well as little opportunity for buying new land for new development. These more inland markets here in eastern Pennsylvania are growing in importance and are significant investment markets. Same effect holds true here on the West Coast. You can see Los Angeles and Long Beach drive a huge amount of demand, but the inland markets. Inland Empire is name of a market you may have heard there. Basically just about 30, 40 miles inland from Los Angeles. One of the largest growing markets in the U.S. and a huge driver of demand for logistics properties. But I think the important thing to realize here is the number of markets around the country. This is the 46th largest industrial property or logistics property markets in the U.S., all of them over 100 million square feet in logistics properties. So those are all significant markets, and some of them have good opportunity for growth. To Dana's comment earlier, I think Phoenix, growing market. It's doubled in size twice in the last 50 years. Huge, significant drivers of growth there. But I think what you find, certainly in our portfolio and what you find in most places, a real concentration around these two markets and the other three major markets in the U.S., Dallas, big Southwest United States driver. Our company is based here in Dallas. It's a convenient location to get to both states, and I heard somebody call it flyover cities. We're definitely in the flyover markets here in Dallas. Atlanta is the big driver of southeastern distribution. That's the #1 cargo airport in the U.S. is based in Atlanta, and drives a significant amount of growth there. And then Chicago, probably decreasing in significance over the last 50 years as the manufacturing economy in the U.S. has decreased, but still a very significant driver of demand. You can see the number of huge population centers. A lot of people don't realize, people think about New York and Los Angeles as being huge population centers, but Ohio, Indiana, and Illinois drive a significant amount of population. Maybe not as much growth as some of the markets along the coast and southern states, but still huge population centers there. So I've now made it, I think, about 5 minutes into my discussion without saying the word Amazon, which is generally how I judge how my investor conversations are going. I think I've heard enough here to know that Amazon is penetrating the German markets like they have the U.S. markets. I have 5 children, and all of them age 22 down to age 5 know how to order on Amazon and order a lot more on Amazon than I do. So Amazon is, and other online retailers are driving significant demand in U.S. logistics markets. There's a lot of stats flying around, and I'm not sure anybody has a great handle on how much demand is being driven by e-commerce, because it's hard to parse through exactly what's being driven by e-commerce as more traditional retailers have actually taken on e-commerce platforms. For instance, even though Amazon is driving a lot of demand, we're actually seeing significant interest from Walmart, as they are now in their 3rd iteration of trying to form an online company. They came into the market on their back foot in a defensive position, but now have fully subscribed to the idea that online retailing is here to stay. I think most of us made that realization a number of years ago, but when you're the size of Walmart, making that kind of decision is significant. So we do expect some competitors to Amazon to come on board. But what we saw last year was, even though e-commerce makes up only about 10 to 12% of total retail sales in the U.S., it accounted for about 25, maybe even more, 25% or more percent of demand for industrial property or logistics property in the U.S. So it's a significant driver, and we expect it to continue to drive demand in the U.S. So I think if you come to invest in the U.S. and you hear the logistics market, there's a diverse type of buildings. The biggest component of that is is the warehouse and distribution market, about 9 billion square feet. But you also have manufacturing, research development, and special purpose buildings. Each of those property types has different components. We focus on the warehouse and distribution. The other plays here tend to be a little bit more niche. And you need to have a much better understanding of those markets before investing in those. So I think some of the things that we think are going to continue to drive the U.S. distribution market. One, we've talked a little bit about continued economic growth in the U.S., even taking into account the potential for a slowdown over the next couple of years. If you subscribe to that belief, we think the long-term prospects are generally pretty good for the U.S. economy, generally driven by the demographics, the growth, continued growth in the population in the U.S., both through a little bit higher birth rate as well as notwithstanding our new president's rhetoric, continued immigration to the U.S. So that's a good dynamics for the overall economy and certainly good dynamics for our sector in distribution. Capital markets is another place, sorry, you keep hitting the wrong button there, but capital markets is another place where the industrial sector or the logistics sector has shown a lot of improvement. Still, in 2017, the highest cap rates of all property sector types, even though I think if you would look at it, some of the most consistent cash flows, as opposed to Dana when he mentioned office, continuously having to invest in your properties through new tenant finish. In the industrial sector, the logistics sector, we make very little new capital investment as tenants roll over. And so that actually, the consistency of cash flows should drive cap rates lower as a property type. So we think as it becomes continues to become a more accepted, more attractive asset class, we'll see cap rates over time continue to compress a little bit. I think as I'm running out of time here, I wanted to talk a little bit about the return horizon. In the last 5 years, the returns for the logistics sector have been very good, at the top of all of the asset classes. But we actually expect that to continue, largely driven by rent growth opportunity in the sector. If you look at where rents are today, we had probably the most significant rent growth in history in the logistics sector last year, averaged about 6.5% across all markets in the U.S., and probably significantly higher in the major markets like Los Angeles and New Jersey, where it was closer to 10%, less so in the secondary markets, but still very strong. So on the strength of that rent growth opportunity over the next several years, we continue to expect to see very good overall returns, probably a little bit less capital appreciation as the chance for a rising interest rate environment to impact cap rates should keep values a little bit lower, but really good, strong income growth and really good overall returns. So again, I appreciate the opportunity to be here, and if you have any questions about logistics property, happy to answer those. Thank you.